Silver just hit 75 bucks. You were right. The whole thesis played out. The manipulation failed. That $50 ceiling that held for like 44 years finally cracked. And now you're about to lose everything. Not because you were wrong. Because you don't understand how this game harvests winners. Let me explain. Most people think the hard part is being right about the direction. It's not. The hard part is surviving the trip. Because the same system that suppressed silver for half a century doesn't just give up when the price breaks out. It adapts. And its new job isn't to stop the move anymore. Its new job is to make sure you don't benefit from it. That's what this video is about, not whether silver is going higher. It probably is. This is about how you lose even when you're right, and how to make sure that doesn't happen to you. Let's start with the first way people lose. Paper exposure in a physical crisis. This one's gonna destroy the most wealth, and the victims won't even understand what happened until it's way too late. Here's the setup. You believed in silver. You bought exposure. Maybe an ETF. Maybe futures. Maybe some certificate from a broker. Maybe shares in a trust that says it holds metal on your behalf. You watched the price grind higher. You felt smart. You told your friends about it. And now silver breaks 75 and you're sitting there calculating your gains. But here's the question you never asked. Do you actually own silver, or do you own a claim on silver? Because those are two completely different things. And in a crisis, that difference is everything. Let me make this really simple. If you hold physical metal in your possession, you own silver. If you hold anything else, you own a promise. And promises are only as good as the moment you try to enforce them. An ETF is a promise. A futures contract is a promise. A certificate is a promise. Allocated storage is basically a promise with a serial number attached. Unallocated storage is a promise without even that. Now here's what happens when silver actually squeezes for real. Industrial buyers need metal, not paper. Actual metal. They need it for solar panels and missiles and medical devices and electronics. They need it to keep factories running and contracts fulfilled. And when they can't get it through normal channels, they start bidding aggressively. Not on the COMEX. In private. Direct deals. Whatever it takes. When that happens, the paper price and the physical price start to separate. You've already seen early versions of this, right? Spot says one number, dealers say another. Premiums expand. Delivery times stretch. Products go out of stock. In a real squeeze, that gap doesn't close, it blows wide open. And here's the brutal part. If you hold paper, you get the paper price. If the system decides to settle your futures contract instead of delivering metal, you get dollars at yesterday's price while the real metal trades at tomorrow's price. If your ETF can't source metal and has to liquidate, you get whatever the market gives you. If your allocated storage freezes withdrawals because of quote-unquote market disruption, you get a statement that says you're rich and a phone that goes to voicemail. This isn't paranoia. This is how systems behave under stress. They don't reward claims. They reward custody. If you hold something you can touch, you don't need permission. If you hold something you can only request, you're asking for permission at the exact moment. Permission becomes expensive. So the first way you lose is simple. You were right about silver, but wrong about the vehicle. And when the moment comes to convert your paper into metal or cash, the conversion happens on their terms, not yours. That's how you win the thesis and lose the trade. Now let's talk about the second way people lose. Leverage. Leverage is how you turn a winning position into a liquidation. And in a volatile market, leverage is basically a death sentence for anyone except the most disciplined traders. Here's how it works. You believe silver is going to 100. You're probably right. So you decide to maximize your exposure. You buy futures with margin, or you use options. Or you buy a leveraged ETF, or you borrow money to buy more. Whatever the mechanism, you're now playing with more than you actually have. And for a while, it feels genius. Silver goes up 10%, your account goes up 30. You're a trading god. Your friends are asking you for tips. Then the volatility hits. See, silver doesn't go up in a straight line. It never has. It goes up violently, then pulls back violently, then rips again. That's how suppressed commodities behave when they finally break free. The moves in both directions are extreme because the market is discovering real price for the first time in decades. And here's what happens to leverage positions in that environment. A 15% pullback that would just be uncomfortable for a physical holder becomes an extinction event for a leverage trader. Your broker sends a margin call. You need to deposit more funds immediately or your position gets liquidated. And margin calls don't wait for you to check your email. They happen fast, usually at the worst possible moment, usually right before the market reverses and rips higher. This is how weak hands get harvested, not by being wrong about the direction, by being right about the direction, but wrong about the timing, by using leverage that couldn't survive the drawdown, by getting liquidated at the exact bottom, then watching the asset rocket higher without them. The system knows this, by the way. The volatility isn't random. The sudden dumps in thin trading hours, the stop hunts, the flash crashes that recover in minutes. These are designed to trigger liquidations, to shake out leverage longs, to harvest the impatient before the next leg higher. Every ounce of paper silver that gets panic sold during a manufactured dip is one less delivery demand the system has to worry about. Every leveraged trader who gets liquidated is one less claim on physical metal. The volatility is a weapon, and it's pointed at you. So the second way you lose is leverage. You were right about silver going higher, but you used a structure that couldn't survive the trip, and you got liquidated on a pullback that meant nothing, right before the move that meant everything. Third way people lose, timing. You know silver is going higher. You've done the research. You understand the supply deficit, you see the industrial demand, you know the manipulation is failing, so you wait for a better entry. Silver's at 75, that's too high. I'll wait for a pullback to 60. Then 60 comes and you think, well, it might go to 50. Then it bounces to 80 and you think, okay, I'll wait for it to come back to 70. Then it goes to 100 and you're still waiting, or worse. You buy at 75, it dips to 65. You panic sell because you think the top is in. Then it goes to 120, and you're sitting in cash, right about the thesis, wrong about the execution, watching other people get rich on your idea. This is timing risk, and it kills more retail investors than being wrong ever does. Here's the uncomfortable truth. You cannot time this market. Nobody can. Not consistently. The moves are too violent, too fast, too manipulated in the short term. The people who win are not the people who bought the exact bottom. They're the people who got positioned and stayed positioned. Trying to trade around a structural thesis is how you end up on the sidelines when the real move happens. Because the real move won't wait for you. It won't give you a clean entry. It won't pull back politely to your limit order. It will rip your face off while you're waiting for confirmation, and by the time you're confident enough to buy, most of the move is already done. Fourth way people lose, selling too early. Silver hits 100. You've doubled your money. Your hands are shaking. You've never had gains like this. Everything in your body screams, take the profit. Secure the win. Don't be greedy. So you sell. And silver goes to 150, then 200, and you're sitting there with your 2x return, watching everyone else make 5x, 10x. You were right, you made money, and you still feel like you lost. This is premature exit risk, and it's driven by psychology, not analysis. Here's what you need to understand. If the thesis is structural, the move is structural. A structural supply deficit doesn't resolve just because the price went up. In fact, higher prices can make deficits worse in the short term because they increase hoarding and reduce recycling. The fundamental imbalance that drove the price from 30 to 75 is the same imbalance that drives it from 75 to 150. The question isn't, has silver gone up a lot? The question is, has the supply deficit resolved? Have they found new mines? Has industrial demand collapsed? Has the paper-to-physical ratio normalized? Has the manipulation reasserted control? If the answers are no, the thesis is still intact. And selling, because the number got big, is not analysis. It's fear wearing the costume of prudence. Now here's the fifth way people lose. And this one's insidious. They lose to themselves. The volatility in a silver squeeze won't just test your positions. It will test your identity. It will test your relationships. It will test your sanity. When silver rips 20% in a day, you'll feel like a genius. When it drops 25% the next week, you'll feel like an idiot. When it's flat for a month, you'll feel forgotten. When it spikes again, you'll feel validated. This emotional roller coaster will exhaust you, and exhausted people make bad decisions. Your spouse will ask why you didn't sell at the top. Your friends will tell you it's a bubble. The news will run hit pieces. Social media will flood with people calling the top. Every dip will feel like the end. Every rip will feel like the last chance. And somewhere in that chaos, if you're not careful, you'll crack. You'll sell at the worst possible moment. Not because the thesis changed, because you couldn't take it anymore. This is psychological attrition, and it's the most underrated risk in any volatile market. The system doesn't just try to take your money, it tries to take your conviction, because conviction is the only thing that lets you hold through the chaos. So how do you actually survive this? How do you hold through the volatility without getting harvested? First, own physical if you can, not all of it, but enough that you have a foundation that doesn't depend on counterparties. Metal you can hold doesn't care about margin calls or withdrawal freezes or cash settlement. It just sits there being silver. Second, if you use paper exposure, understand exactly what you own. Read the prospectus, know the redemption terms, know what happens in a market disruption, know whether they can cash settle, know who the counterparties are, don't assume, know. Third, don't use leverage you can't survive. If a 30% drawdown would liquidate you, you're not positioned for this market. You're gambling, and the house always wins against gamblers eventually. Fourth, size your position so you can hold through anything. If your silver position is so big that every tick affects your mood, it's too big. If you're checking the price every 10 minutes, it's too big. If a 20% drop would force you to sell other assets, it's too big. Size for survival, not maximum gain. Fifth, have a thesis, not a price target. Know why you're in this trade, write it down, and don't sell until the thesis breaks, not until the price scares you, until the actual structural reasons change. Sixth, expect the manipulation, expect the volatility, expect the FUD, expect the hit pieces, expect the flash crashes, expect the margin hikes, expect everything they've done before, because they'll do it again. The playbook doesn't change, only the price level changes. Seventh, get off the screen. Seriously, if you're positioned correctly, you don't need to watch the daily candles. The daily candles are noise. The thesis is signal. Watching the noise will drive you crazy and tempt you to trade. Don't trade. Hold. Here's the truth nobody wants to hear. Most people who are right about silver will still lose money. They'll lose it to paper structures that don't deliver. They'll lose it to leverage that gets liquidated. They'll lose it to timing mistakes and premature exits and psychological warfare. They'll lose it because they treated a structural thesis like a short-term trade. Silver at 75 is not the finish line. It's the starting gun. The real move hasn't happened yet, and the real test isn't whether silver goes higher. It's whether you're still holding when it does. So here are my questions for you. 1. What percentage of your silver exposure is physical versus paper? 2. If silver dropped 40% tomorrow and stayed there for 6 months, would you hold or would you sell? Be honest. Drop your answers in the comments because I want to know who's actually positioned to survive this and who's going to get harvested. And if you want the next breakdown on how to actually structure your position for what's coming, subscribe now, because the volatility's just getting started.